I want to walk you through something that's been circulating recently, and not from a headline perspective, but from a how housing actually works perspective. A lot of people are watching the Federal Reserve right now, waiting for rate cuts before they make a move. That's understandable. But it assumes the Fed is the only lever that matters in housing. It's not. There's been discussion around a housing strategy tied to the Trump administration that focuses on Fannie Mae and Freddie Mac, not the Federal Reserve. This idea was explained publicly by investor and author Robert Kiyosaki. Now, whether you like or dislike Trump has no bearing on whether this strategy makes sense. Housing policy isn't about personalities. It's about incentives, liquidity, and system stability. So let's slow this down and explain the basics, because this part is usually skipped. Fannie Mae and Freddie Mac were created after the Great Depression for one reason: to keep housing from freezing. Because when banks stop lending, housing stops. When housing stops, the economy follows. Their job is not to lend money directly to you. Their job is to buy mortgages from lenders, bundle them into securities, and sell them into the financial markets. Now, what is a mortgage-backed security? A mortgage-backed security, or MBS for short, is basically a bond. It's made up of thousands of home loans. So instead of a bank holding your mortgage for 30 years, they sell it into this pool that does two important things. First, it protects lenders. They get their money back quickly, which allows them to make more loans. Second, it creates liquidity, meaning mortgage money keeps circulating instead of getting stuck. This is where affordability comes in. When lenders know they can sell loans into a strong secondary market, they're more willing to lend and to lower rates. Risk is spread out. Capital keeps moving. That's how the system was designed to work. Now, what type of loans do Fannie and Freddie support? Fannie and Freddie primarily deal with conventional conforming loans. They do not insure FHA loans. That's handled by the government through FHA itself, which is the Federal Housing Administration. But FHA, VA, and USDA loans still benefit indirectly because they all rely on the same mortgage-backed securities ecosystem. Now, when liquidity improves in the overall mortgage market, pricing improves across the board. Now, let's clear up this balance sheet because there's been some confusion about the money involved, so let's clarify. Together, Fannie Mae and Freddie Mac have the capacity to deploy up to $200 billion toward buying mortgage-backed securities using balance sheet resources they already have. This is not new money. It's money already inside the housing system. Why is this not quantitative easing? This is where people keep using the term quantitative easing, and it's not quite accurate. Traditional quantitative easing happens when the Federal Reserve creates new money and uses it to buy assets like treasury bonds or mortgage-backed securities. That does expand the money supply, and historically, that kind of quantitative easing has contributed to inflation because more money is chasing the same goods. What's being discussed here is different because no new money is being created. This is housing infrastructure using its own capital that it already has. You'll hear the word yield a lot. A yield is simply the return an investor gets for holding a security. When demand for mortgage-backed securities goes up, prices rise. When prices rise, yields come down. Lower yields mean lenders can offer lower mortgage rates. That's the connection. So how does this affect rates? If Fannie and Freddie become buyers of MBS, mortgage-backed securities, it can apply downward pressure on mortgage rates. Not dramatically, not overnight, but enough to matter. This doesn't replace the Federal Reserve. The Fed still controls short-term interest rates and broader monetary policy. This is a parallel housing lever, not a power grab. I know there's some things swarming around the Fed chair with Jerome Powell. This is not what this video is about. But as of now, there is no confirmed investigation tied to this housing strategy. It is important to separate speculation from structure. Now, people often point to Canada as an example of what the Trump administration is considering because Canada has used government-backed mortgage liquidity programs for years through its housing agency, Canada and the Housing Corporation. Canada Mortgage and the Housing Corporation. So during periods, especially like COVID, the government stepped in heavily to support mortgage liquidity. And over time, Canadian home prices increased significantly, in some markets nearly doubling over a decade. Now, that wasn't caused by one single policy alone, but it does show what happens when demand is consistently supported while supply lags. Why does all of this matter? Because lower rates doesn't automatically mean cheaper homes. They usually mean more activity. Buyers come back into the market, investors usually move first, and then homeowners begin to reassess their options, and then builders begin to regain confidence. Housing is one of the most protected systems in the economy, not because it's fair. That's a conversation for a different day, but because it's foundational. Banks, pensions, insurance companies, and tax revenue all sit on top of it. So the goal is not collapse. The goal is movement without failure. I must say that this is educational commentary, not financial advice, because policy can change. Every situation is different, but understanding how the system works puts you in a stronger position than waiting for headlines. I'm not here to predict the future. I'm here to help you understand the structure while it's still forming. Because in housing, clarity always beats reaction. Thanks for watching.